Dear members, dear participants, dear friends, welcome to ATEL Annual Conference. I wanted to welcome all of you and to thank you for taking the time to be with us today. By the way, the content will be accessible in replay tomorrow morning on mytreasurytv.com if you want to share it or watch it again. Our objective is to soon welcome all participants physically. So let's start. The general theme of today's conference is embracing digitization. After a major financial crisis, what are the best responses to become more resilient? More than ever, CFOs and treasurers must modernize finance organizations to match coming challenges and become more agile and resilient to crises. The health crisis can be a fantastic catalyst for solid enhancements. Treasurers should not miss this opportunity, or they may be at risk. They need to build on experience and anticipate future needs for generating strategic value for the company. Before starting, I wanted to thank all of our 6 sponsors, BNP Paribas, EY, JP Morgan, Intensum, ING, and Bearing Point for their support. Enjoy your e-conference. First, I would like to introduce our next speakers from EY, who will talk about transfer pricing and tax issues. We have the pleasure to welcome Daniela Hockelmann and Nicolas Gillet, experts in taxes and TP. They will give us useful pieces of information about the new and hot topics in terms of taxes and transfer pricing for the year to come. We all know that these two key elements are impacting our treasury day-to-day activities and will continue to keep us busy. Let's be prepared. Daniela, Nicolas, the floor is yours.
Good afternoon. Welcome to our presentation on what is new and hot in the Luxembourg tax and transfer pricing environment. Together with me is Nicolas Gillet, who is leading our transfer pricing team at EY Luxembourg. I am Daniela Hockelmann, associate partner in our international tax practice. In the next 30 minutes, we'll walk you through a couple of recent developments and trends we are seeing in the Luxembourg tax and TP world, which we think can be of interest for companies performing financing and treasury activities in Luxembourg. We first take a look at some selected aspects of the recently issued OECD report on financial transactions to see what it means for treasury activities. After that, we'll talk about other interesting tax aspects and trends that could impact financing and treasury in Luxembourg. As part of that, we look into, in particular, at a draft law limiting the deduction of certain payments made to blacklisted countries and speak about a trend that we are seeing in the field of tax controversy. Let's start with the new OECD report on financial transactions, or Chapter 10, how it is sometimes referred to. And the question, is it a game changer or just business as usual?
Thanks, Daniela. So, as you said, transfer pricing experts have been actually waiting for this paper for quite some time now, as it was debated at OECD level for some years. As you might know, the OECD guidelines describe how intra-group transactions should be priced. OECD guidelines comprise 9 chapters, but no chapter specifically focused on financial transactions. So the point has been resolved now with the release of this new Chapter 10, which is fully dedicated to the pricing of intra-group financial transactions. As Luxembourg has only introduced Chapter 1 to 3 of the OECD guidelines in its legislative framework, we believe that a change in law would be necessary to implement Chapter 10 in its entirety in Luxembourg. As Chapter 10 is the application of Chapter 1 to financial transactions, some of its content might, however, be used by the Luxembourg tax authorities or potentially by a judge either to interpret certain sections of the current Luxembourg law, or it could serve as a guidance for matters that are not currently being dealt with by Luxembourg law, like, for instance, debt-to-equity ratio, or that we'll also cover later on in this presentation. So in particular, Chapter 10 defines whether a financial transaction should be regarded as a loan or not as a loan, and provides a methodology to define the quantum of a debt on one side and the amount of interest to be applied on a debt on the other side. So both components will determine the interest deductible on such a debt. In order to arrive at the amount of interest to be deductible on a given loan, Chapter 10 recommends a two-step approach. So the first step, step 1, that you will see on the left-hand side of the slide, will consist of analyzing the commercial rationale and the terms and conditions of financial instruments used in a financial transaction. The second step, step 2, that you see on the right, will consist of the actual pricing of the transactions. And the OECD probably felt that TP specialists were spending a lot of time on the second step, being the pricing of the transaction, but that the first step was not covered in a lot of details, actually, in transfer pricing studies. So now let's look at the main points of this two-step analysis in a bit more details. Let's start with commercial rationale. We need to ask what would be the behavior of a third party and whether a third party would actually enter into such a financial transaction. So for example, if a borrower has a lot of cash available and has to finance a short-term asset, would the borrower actually enter into a loan transaction? Similarly, if a borrower is in a very bad financial situation, would a lender agree to provide a loan to this borrower?
This aspect is also very relevant if you think about a Luxembourg company that is financed with an interest-free loan. In such cases, it may not be so obvious why actually a third-party lender would grant such a loan. In order to counter potential challenges on the commercial rationale behind such an interest-free loan, our recommendation is to critically assess whether the terms of the loan should be adjusted to reflect a little bit of a more balanced transaction.
Yes, and we also need to ensure that terms and conditions of the financial instruments are at arm's length. So one has to demonstrate that third parties would agree to use similar terms of financial instruments under similar circumstances.
For instance, if the maturity indicated in a loan agreement should be the one that third parties would be willing to use. In order to finance an asset where the expected cash flows to be generated could be estimated on a 5-year basis, a loan above a 5-year maturity could be difficult in practice to justify.
Yeah, and a third aspect we wanted to also to highlight is that Chapter 10 introduces the concept of options realistically available. So what do we mean by that is when we have both of the lender and the borrower's perspective that should be considered. So for example, a lender might have different options to use his cash, and the fact of granting a loan would not necessarily be the best option for him. On the borrower side, even if it would have the capacity to borrow additional money, a borrower might choose not to do so in order to avoid placing too much pressure on his solvency or credit rating. So perspective of the lender and perspective of the borrower have to be considered here.
And the above aspects are not only relevant from a transfer pricing perspective, but there can also be practical implications from a tax perspective, which taxpayers should keep in mind. For instance, in the last few years, there has been case law in Luxembourg which Luxembourg courts have qualified a loan as an informal capital contribution if the normal way of financing would have been a capital increase. In these cases, the courts concluded that the intention of the company was to provide additional equity to the subsidiary rather than to act as a lender. Now, if you look at the criteria which are used by the courts to qualify the loan as informal capital contribution, there may be certain similarities to the indicators given in the OECD report on analyzing other options realistically available. So in summary, I would consider that the new transfer pricing aspects may be used by Luxembourg tax authorities also as an inspiration for the application of already known concepts.
Okay, so another key element is the assessment of the debt-to-equity ratio of the company. We believe that this is a new point to which further attention should be paid. And based on our analysis, the assessment of the debt-to-equity ratio should be applicable to Luxembourg companies which are issuing loan or implementing cash pool arrangements after the issuance of this paper, i.e. after February 2020. The terms of the debt for the investments need also to be aligned to the company's ability to service the debt, right?
Yeah, what's the tax risk if you get it wrong? Well, if the debt to equity ratio turns out to be excessive based on the transfer pricing documentation, the interest expense on the excess debt could be requalified into a hidden dividend distribution. And as a consequence of that, the excess interest expense could become non-deductible for the company. And depending on the circumstances, there could also be a withholding tax applied to the hidden dividend amount.
For cash pool arrangements, documentation of the interest rates and the commercial rationale of the cash pool transactions should be performed. Debt to capacity analysis depends on the functional profile of the cash pool leader. As we will see later, a cash pool leader performs either coordination or agency functions, so more limited functions, or a role going beyond this coordination or agency functions. In case where the cash pool leader acts more as an in-house bank, and when the cash pool arrangements are implemented after February 2020, an analysis needs also to be performed to estimate the appropriate amount of equity and debt at the level of the cash pool leader. Hence, a justification for the equity amount for entities performing cash pool activities will have to be prepared. This is an important point, an important change to point out. The functions and risks should also influence the debt to equity ratio to be applied for the companies. For intragroup financing, so the typical back-to-back transactions that have been put in place in the past where appropriate TP documentation was prepared, we expect a limited impact of the OECD paper on those structures. Particular attention has to be paid to the characteristics of the financial instruments to be used. Such characteristics have to be arm's length, and the appropriateness of the use of such instruments would have to be justifiable in the circumstances. So another point of Chapter 10 is the creditworthiness of the borrower and the determination of the credit rating, which is one of the other factors that independent lenders consider in determining an interest rate. So the guidelines elaborate on how to estimate credit ratings. The OECD guidance specifies that an issue rating represents an opinion about the creditworthiness of an issuer with respect to a specific financial instrument. Conversely, an issuer credit rating is an opinion about the general creditworthiness of an issuer. So when both credit ratings are available, preference should be given to the one using the rating to price on the financial instruments, right, for these event transactions. According to the OECD guidelines, commercial credit rating tools may also differ significantly from the credit rating methodology applied by independent credit rating agencies. So the first criticism made by the OECD is the lack of clarity of certain tools, and because the algorithms and processes underlying the commercial credit rating tools may not be fully transparent, according to OECD. Secondly, commercial credit rating tools often use a limited sample of quantitative data to determine credit ratings. So the OECD guidance then recommends using quantitative data to price the interest rate, but also qualitative data, such as industry-specific features, for instance. Another factor that may impact the credit rating of a borrower is the implicit support from the group. Entities of the group will be more or less likely to receive such support according to their relative importance to the group entity and the linkage between the entity and the rest of the group. So the OECD recognizes that the credit rating of an entity could be enhanced by being part of a group. So this is what we call the halo effect. So now, going to the remuneration of cash pooling structure, so Chapter 10 also provides insights on the pricing of cash pool arrangements. As previously mentioned, the first step would be to accurately analyze the cash pool transactions. So such analysis will depend on the facts and circumstances, but also on the wider context of the conditions of the cash pooling arrangements. The analysis is key. We need to analyze where members of a group maintain debit and credit positions on a long-term basis. The OECD guidelines recommend treating these balances as long-term deposits or loans, And we are aware of recent controversy between German and Dutch tax authorities regarding recharacterization of cash pool balances into long-term loans with corresponding higher interest rates. We therefore stress the importance of having appropriate TP documentation in place supporting the short-term nature of cash pool transactions. In order to price cash pool transactions, the first step is to estimate the remuneration of the cash pool leader by analyzing the facts and circumstances and the functions performed. In general, a cash pool leader performs no more than coordination or agency functions, hence deserve a very small remuneration, typically a cost-plus remuneration. It will receive a higher remuneration if the cash pool leader performs more functions and assumes more risk beyond such coordination or agency role. So, in a second step, once the remuneration of the cash pool leader has been calculated, residual cash pool benefits needs to be allocated to the cash pool participants. Given the current negative interest rate environment, the cash pool benefits could be allocated, for instance, to the cash pool participants depositing in the cash pool by setting, for instance, a 0% floor rate on their intra-group deposits. So overall, as a conclusion of Chapter 10, the introduction of this Chapter 10, in existing structures, so beyond the traditional documentation of the arm's length interest rates and the margins, further attention should be paid to the documentation of the commercial rationale of your financial transactions, including a review of the terms and conditions of the loan or cash pool transactions. For financial transactions entered into after the issuance of Chapter 10, so post-February 2020, particular attention should be paid to the documentation of the debt-to-equity ratio used, i.e. looking at the quantum of the debt and not just the pricing of the interest rate on the loan, in addition to the documentation of the commercial rationale of the financial transactions. In particular, the amount of equity at the level of cash pool leader needs also to be assessed, especially, as I said, when they assume a role going beyond coordination or agency functions, like in-house banks, for instance. So we strongly recommend to Luxembourg taxpayers engaged in intra-group financial transactions to review the compliance of their transactions and related transfer pricing documentation with this new guidance.
Thanks, Nicolas, for the explanation on the new Chapter 10, which is, well, without a doubt, one of the most important tax and transfer pricing evolutions of the year. I wanted to take the opportunity to also speak a few minutes about some other interesting developments and trends in Luxembourg taxation. First topic we wanted to cover is the draft law on the payments to non-cooperative jurisdictions. The draft law was submitted to the Luxembourg Parliament in March this year, and it aims at disallowing, under certain circumstances, the deduction of interest and royalties paid or owed by a Luxembourg company to related corporations that are established in a country that is listed on the EU list of uncooperative countries for tax purposes. The new provisions are expected to apply as from 1st of January 2021, so next year. The EU blacklist is under constant changes, and it currently includes 12 jurisdictions. Among those are the Cayman Islands, Panama, the US Virgin Islands, and the Seychelles, for example. Well, where does this legislative initiative actually come from? What Luxembourg aims at doing with this draft law is that it implements guidance that was given by the EU Code of Conduct Group for Business Taxation. So it's a European initiative. The details of the draft law are more complex. For example, it refers to beneficial owner, and there's also a safe harbor rule in case the transaction is entered into for valid commercial reasons reflecting economic reality. But the important takeaway for Luxembourg companies that receive loans or licenses from somewhat more exotic countries is, first of all, to have this on the radar, and secondly, to keep an eye on the evolution of the EU blacklist and the resulting domestic blacklist, because some countries may be added to it, some may be taken off. Another trend that we wanted to highlight here is an evolution over the last few years actually already towards an increased number of tax disputes with the Luxembourg tax authorities. So What we are seeing is that tax audits and requests for information by the tax authorities are in sharp rise. There's also the trend of tax authorities challenging technical positions is growing. There are more frequent appeals against tax assessments, and the number of tax controversy cases before tax courts is rapidly increasing. Now you may ask the question, why is that? To a certain extent, this is due to the following. EU and international pressure on Luxembourg provoked actually a visible attitude of the tax authorities towards more controls and challenges. Recent developments on the international tax landscape also play a role here. A multiplication of disclosure requirements coupled with, well, more enhanced technology, that's also playing a role, but certainly it's also due to the fact that the number of tax ruling applications in Luxembourg is really in strong decline, and the frequency of meetings and the level of communication with the tax authorities are at a historic low, and that altogether, well, leads to less dialogue and more confrontation. To give you some examples of points of contention we've witnessed so far, the cases include, for example, the non-recognition of foreign permanent establishments, and that also affected foreign finance branches, the cancellation of a fiscal unity, or the non-application of tax rulings, the application of anti-abuse rules, just to name a few. But irrespective of the specific point of contention, it is important for you as treasurers to understand that in many disputes there are substantial amounts at stake, and this may have a considerable impact on the cash and liquidity situation of your company. In such a situation, we think it's very important that you early seek professional advice on how to manage and resolve the dispute in the company's best interest, but also to see how to avoid cash expenses by requesting payment deferrals and installments with no or just at a low interest charged. As a last item, I wanted to mention, before we close, I wanted to mention something on tax compliance. Most taxpayers are currently preparing their 2019 corporate tax returns. And as you may remember from previous presentations, this is the first year, 2019 is the first year where the new interest limitation rules are applied. The forms for the 2019 tax returns have recently been issued, and well, it's no surprise that they also comprise some additional forms that need to be completed to reflect the new rules. As a reminder of one of the technical specifics to it, one important aspect can be to assess to which extent a taxpayer can rely on grandfathering. And this does not only require that a specific debt was already in place before June 2016, but in practice it will entail a whole analysis of potential changes to the amounts or the terms of the debt, which is something we wanted to mention here, since I could imagine that one or the other of you may be asked to assist in this process, which, by the way, needs to be done before the tax return can be completed. Well, with this reminder on the interest limitation rule, we wanted to close our brief overview on the important tax and transfer pricing developments. Thanks for joining. We hope you liked our selection of the topics. Of course, please don't hesitate to reach out to Nicolas or myself if you need any assistance on the aspects that we have covered.
Thanks a lot for this very interesting presentation. And now I would like to introduce the theme of our next presentation, COVID-19 and beyond, your 2025 Treasury. Our speaker, Jan-Dirk van Beuzekom, Head of Strategic Marketing, Cash Management and Trade Solution at BNP Paribas, will talk about the digitization challenges and impact of viruses, the real and the virtual ones, on your treasury processes. He will also define what your 2025 Treasury will look like. As a motto at BNP, we are in this together and we will solve it together. The future lies in cooperation and innovation. Jan-Dirk, the floor is yours.
Hello and welcome to the session on your Treasury in 2025. Thank you, François, for the invitation to return to this forum and address the ATEL audience. It's a great pleasure to be here today with you and discuss a picture of the future. A future that has already started and that we can structure together. Why I believe that I tell you later. With technology, we're capable of creating a picture of the future in theory. You must have heard of the film Interstellar, where scientists were in charge of the decors and images. They created a picture of a black hole purely on theory and technology, as no image of a black hole was available at that stage. Until last summer, when other scientists produced the first real picture of a black hole, taken by the strongest telescope, and the images resembled remarkably. One of the reasons I believe in technology to create images of future and being stronger together. My name is Jan-Dirk van Beuzenkom and I'm a treasury and working capital expert. I worked as a corporate treasurer, as a consultant and a banker, and I am currently responsible for strategic marketing of cash and trade solutions of BNP Paribas Group. I am also one of the founders and contributors of the Journey to Treasury, which you can download on www.journeystoTreasury.com. The 2020-2021 edition, the fifth, has been released just a few days ago. I understand I'm between you and the drinks, so let's get quickly to business. Why is an image of the future important for you? Because, contrary to controllers and accountants, treasurers always look forward. Because treasurers are responsible to give an accurate prediction of the future, of the financial cash flows of the company. To be able to do that, you need a glass ball, or theory and technology. Some circumstances, however, are very, very unlikely to occur and hard to predict. Like the contamination by virtual or real viruses, for example. At the first initial shock, you set to work your business continuity plan and remember to adjust it for the next wave or black swan. Then you redefine your financial supply chain and start to rebuild. The current crisis has proven that through these stages, technology and the application of digital techniques have been used exponentially. For instance, the use of our electronic tokens for dual authentication in our e-banking systems have increased from 20 to 70% in the first 3 months of the pandemic. But what did you do? Although the EACT summit sadly could not take place this year, 200 Treasury professionals from across Europe shared their thoughts on Treasury's role and priorities as part of the EACT survey. Survey responses were received between the 11th of March and the 15th of April 2020, a period which coincided with the start of COVID-19 lockdown for many countries. Although some survey participants responded to the survey before the official lockdown in their respective countries, many companies had already implemented measures such as stopping business travel and moving to home working. Markets were also experiencing significant volatility at the start of the survey period, and supply chains had been disrupted. Consequently, it would seem fair to assume that most people responded to the survey in the context of COVID-19 related issues. Let's look at the results of the EACT survey. The first question is about which of the following are likely to be your major priorities over the next 12 to 24 months. Cash flow forecasting is the top priority on the Treasurer's agenda. With the COVID-19 crisis, this is not a big surprise, but it should be noted that cash flow forecasting was also of major interest in the responses collected before the crisis and is still a challenge for most organizations. The major trends stay around the core activities of the treasurers, with treasury technology, infrastructure, working capital management and digitalization of treasury being rated very high this year again. The second question was, which of the following innovations are you currently using? And we see that data analytics and robotic process automation are very much in use or of interest by lots of corporates. These survey results confirm the trends observed in the past EACT surveys, with RPA usage interest increasing from 24% to 46%, and data analytics from 43% to 62% compared to last year's results. Artificial intelligence is improving the industry processes, creating new ways to work. This year again, cryptocurrencies and blockchain are not widely adopted or of interest in the next 12 months. For the third question, which of the following are likely to be of the greatest interest? And we see that real time is frequently analyzed in details and part of the GTT editions, and again came on top of the list. Many players in the ecosystem were at your side with practical and theoretical support, as we were all contaminated and implicated. One of these supports came from BCG, which seems very sound business practice for the future to me. It's about centralization. Second, revisit your cash flow forecasting. The third, be prudent with liquidity and bring all financial short-term and long-term flows together. And bring all operational cash flows in the equation as well. The latter is a free advice from my side to include procurement and the commercial department in your scope of influence as well. Only by doing that, you will be able to manage the full financial supply chain. Control and visibility by centralization. Why centralization? Because it's my belief it will in general increase control and visibility of your cash. One of the most important tasks of Treasury Department is to know where is my cash and why. The more you centralize, the more visibility and control you will have. The journey starts with the integration of your systems. Have one version of SAP, for example, and integrate your TMS, e-banking, and maybe even some fintech solutions. Have as many accounts as possible in your pooling structure to increase both visibility of your balances and control over them. Account structures and the payment factory with POBO and or COBO could be the next step. Could be, as the optimal model will be different per corporate. You can't implement all this without a sophisticated in-house bank structure. And what about digitalization or virtualization of account structures? It's a common misperception that virtualization is the final step in attaining the highest level of treasury maturity. Virtual account numbers and virtual accounts can be implemented at any level of treasury maturity. Bypass the traditional maturity model and have higher returns on investment compared to treasuries without virtualization. This is just one way how we see and develop our joint future together. One of the initiatives we started in 2017 is the Treasury Board. The Treasury Board is formed by a representative club of our Tier 1 clients and our top management, and our two-step approach to co-creating the future of Treasury together. In step 1, we listen, discuss and create new ideas. In the second step, we co-create and deliver. The concept is now applied in Europe and Asia, and in November we will have the first Treasury Board in the Middle East. Let's look at a few of the Treasury Board projects. After the first step, each new project will go through the 9 phases of co-creation before being applied as a solution. The balls indicate in which phase a project is. Cashboard, about data analytics, and Bennett Tracker based on Swift GPI are fully live. Payment Watch is in pilot phase and enhances the detection of fraudulent transactions. The seamless treasury journey is long. However, parts of it are live, such as Welcome, our onboarding and KYC tool, which I'll come back to later in the presentation. Some new projects include the B2B working capital supply chain journey, automated investment from the master pooling account or plug-and-play solutions for green bond issuance. Regarding onboarding and KYC, expectations have not changed considerably due to COVID. Different banks ask for different documents and information. There is no common standard. You had concerns about security around who was viewing personal documents. We had to deal with several contact points, different people within the bank, and inconsistent requests for information and documents. We asked regularly for documents that are already available, and accounts opening took longer than expected. That's why we digitalized the Know Your Customer KYC and account opening, and it has become key for you. Our welcome tool for onboarding and KYC is now live and available in 11 countries. Account opening and e-signatures have been or will be soon included, and we keep adding new features and continue the rollout to other European countries. Next to KYC and onboarding, the other nightmare I experienced as a treasurer myself was my CFO, or even worse, my CEO, stepping into my office, asking, where is our cash? How many accounts do we have? Do we need them all? Is all cash centralized? Can we control it? Etc., etc. Do you recognize this? Then Cashboard is something for you. What does it enable you to see and do? Well, it talks about the number of accounts you have, if they are active or inactive, how many accounts are pooled, how many payments have you made, what are your collections, what channels do you use to communicate with your bank and your bank with you, what are the outstanding service requests. A new upgrade, including trade info, will be released next month. It's not a TMS. It serves, for instance, as a quarterly review to see if your treasury structures are up to date and most efficient. In the last edition of the GTT, it features a cash study of Zootis and Cashboard. Cashboard contains an overview of BNP Paribas information, and billing info is the next development. This page shows you the accounts that are active, inactive, and where they are located, etc. The liquidity page shows pooling data, the average balance per month, countries and accounts participating and contributing, for instance. And on the last slide on the subject, finally, connectivity shows which channel you have used to make payments, and an analysis of methods of collection and payments used, for instance. Not only methods and tools have changed, also the business environment changed completely, which means we have to adapt our business models and the way we look at competition. We compete on user experience, which needs loads of creativity and imagination to meet the increased user expectations of our respective clients. We need to be resilient where it comes to virtual and real viruses, climate change, etc. Lifelong learning is more important than ever. We create communities, which we do on cybersecurity, CSR, payments and treasury in general. A good example of that is the Journeys to Treasury with our partners EACT, SAP and PwC, and another example is our Treasury Board as discussed. For both communities, I invite you to become part of it, either by registering your interest on our website or by following our LinkedIn page with over 10,000 followers currently. Agility for us is become more adaptive and more human. Augmented innovation with a distinctively human touch. I think with our initiatives, we offer exactly that, and I'm happy to take your questions now, if any. Thank you very much for your questions and listening. If you'd like more information on the subjects discussed, please do not hesitate to contact me. My name is Jan Dirk van Beuzenkom and I wish you a very enjoyable rest of the day and cocktails, of course.
Thank you, Jan Dirk, for this very instructive presentation. And now I would like to introduce Bearing Point, and they will talk about the impact of COVID on payment and digitization. Guys, the floor is yours.
Hello, thanks for watching this video from Bearing Point on digital payments. Bearing Point is an independent business and management consulting firm with around 4,500 consultants. If we include our partner consultancy firms, we are more than 11,000 consultants, giving us a global reach that allows us to follow our clients wherever needed. In this video, Karim Doudou, Senior Business Development Manager of Bearing Point Luxembourg, and myself, partner at Bearing Point Luxembourg, will give our point of view on the changing payments landscape. The changes are complex. Some analysts even speak of a revolution. Hence, in the coming 50 minutes, we will be able to touch only the surface of the important challenges we are facing. Karim, maybe you can give a global overview of what's happening.
Yes, so for several years now, the payments area has been forced to transform itself. This amazing evolution results from the combination of several factors. First, this is due to new regulatory initiatives. PSD2 was designed to open up the banking industry to new players and promote the development and use of innovative online services while ensuring also consumer protection. It has provided the foundation for open banking, granting access to payment accounts. This framework has created also new opportunities with the emergence of a pan-European market open to new players, GAFAM and FinTech entering the playing field. This transformation is also driven by the adoption of new and innovative technologies, to name only two, artificial intelligence and blockchain. According to an IDC survey, financial services companies will spend $11 billion in 2020 in artificial intelligence, with substantial, of course, rewards expected in the midterm. Artificial intelligence can be used to fight fraud, and particularly for e-commerce transactions, enable and offer better and cheaper customer services with the presence of chatbot programs, for instance, and allow digital interactions for consumers, like with mobile payments and online banking. Blockchain also brings interesting assets like embedded cryptography, resilience, distributed lead data, and tamper-proof processes. Of course, the use of these new technologies is made possible thanks to a deep modernization of payment infrastructure. Such initiatives are usually led by governments, central banks, and as seen previously by regulators, in order to lead to efficient clearing and settlement systems, support real-time, and meet end users' expectations in terms of digital experience and payment security. To take the European example, the Eurosystem has launched a project to consolidate Target 2 and T2S to create a consolidated platform that will be launched in November 2022. This will feature a centralized tool that will allow participants to steer, manage, and monitor central bank liquidity across all target services. As a result of this evolution, what is key is the emergence of new customer behaviors, also fastened by COVID-19 with the spreading usage of contactless payments. So, based on this, financial institutions have to transform their payment business model. Eric, maybe we can now go further into detail with some major trends?
Yes, of course. The first one is changing consumer habits. We all notice that our payment habits have changed compared to those of our parents. The use of classic methods like cash, check, and credit cards are progressively replaced by mobile payments and even digital currencies. The sanitary crisis has accelerated the use of online payments, with a rise of e-commerce by 20% during the quarantine and the shifts to contactless payments. Regarding the future of digital means of payments, there is of course the very likely disappearance of checks, since it's not even used anymore in many countries. The usage of credit cards is under pressure by mobile payments and new hybrid solutions such as Apple Pay. Instant payments is a further threat for credit card usage. In the developed countries, there will probably be a place for different forms of payment, but on the contrary to emerging countries, the transition directly from cash to mobile payments without ever owning a plastic card will not be the case. Regarding cash, the trend is now to use it for small payments, and several countries have even removed large notes from, for example, $100. However, cash still has interesting properties: anonymous, accepted almost everywhere, secure, no cyber attacks, and allowing people to feel better when they spend. So, Karin, maybe now we should talk a little bit more on the effects of digitization and data.
Yes, so Thanks, Harry. Indeed, these new habits push towards digitalization transformation and create value disruption for banks. Having based their revenue model on transaction fees that tend to decrease to be free in the future, payment services providers must evolve towards data-driven services model. Data is the new gold and bring new opportunity for banks and corporates. Therefore, using data will be a decisive differentiating factor for banks and other players. So how can they benefit from it? A data-driven value creation strategy is made possible using emerging technologies, and as you can see in the scheme behind, requires a personalized, scalable, and efficient information system that collects and stores large amounts of data, which means an ability to unlock data sources and allow implementation of analytical capabilities that are key for data exploitation. Data exploration offers internal opportunities and values for companies, like the ability to improve product development, target market and sales efforts, drive operational efficiency, and enhance risk and fraud management. These value-added services will be a benefit also for customers. For example, the provision of specific advice in real time. And of course, this is the opportunity to generate new revenue stream for payment services providers. But these new technologies also need a reinforcement of cybersecurity.
Indeed. Thank you, Karin. The risk of fraud needs to be handled carefully. As you can see here, we have some statistics from American Express Digital Payments Survey led in 2019. 70% of online sales end up as fraudulent transactions. 69% of the merchants in the US are spending significant time and expense to dealing with payment fraud. Luckily, existing regulations already provide strong guidelines and requirements to ensure security and fraud. PSD2 provides regulatory technological standards on strong customer authentication and secured communication, which highly contribute to enhancing transaction protection, promoting innovation, and improving the security of payment services across the European Union. New methods also contribute to solve current fraud issues. With the development of biometric identification, consumers can now use fingerprint or facial recognition to unlock a mobile phone. We also see government initiatives that aim at reinforcing operation securities, like the Indian government that has collected biometric data, fingerprints, retina scans, and facial recognition from more than 1.2 billion of people. We just must be careful that these security requirements keep enabling an easy and fluid usage of new payment needs. And of course, Karin, there are also the geopolitical challenges.
Yes, of course. And the fourth and last trend is about international competition. Beyond consumers' habits and the new power of data, the transformation of payments landscape leads to a hard competition, having profound consequences on economic and generating geopolitical strives. Christine Lagarde admitted in early September in an ECB speech that Europe has fallen behind in this competition, allowing foreign providers to take the lead. If we have a look towards the Asian area, China is developing a world-leading digital payment infrastructure, as well as India. Their online payment represents almost 3/4 of gross domestic products, and almost 50% of in-store purchases in China are made via digital wallets. The country is also working on a digital currency back to its central bank that can be used as a power tool, since companies doing business in China are forced to adopt the digital one. This could lead to the erosion of the dollar's primacy in the global financial market and shift the epicenter of global economic power. In parallel, technology firms like GAFAM are also affecting European payments. If we take the example of Facebook, it leverages on its network to develop and expand Libra footprints. But many risks are raised by the creation and usage of these private cryptocurrencies. Market abuse power, question of the ownership of critical data, volatility and potential convertibility issues, and monetary sovereignty that could also be weakened. To face this evolution, first, the Eurosystem has already reacted by the launch of technological initiatives like Target 2 consolidation. And we can also mention EPI, the European Payments Initiative, with the ambition to create a unified pan-European payment solution based on instant payment and SEPA. Secondly, Christine Lagarde has announced a few days ago that the Eurozone central bankers are close to deciding on whether to press ahead with the development of a central bank digital currency, the CBDC. When we have a look to other international initiatives, we see that the first stablecoins was created in 2014 to minimize price volatility, and many governments have already started to issue their own cryptocurrency. For instance, the USA created the USD coin in 2018. The Central Bank of Sweden also announced a new krona and started testing the proof of concept in 2020. China has the digital yuan and India the digital rupee. Therefore, it's really time for Europe to have its digital euro. So in summary, we can say that there are quite some challenges.
Yes, as explained previously, the payments landscape is changing quickly. Numerous and concurrent initiatives are occurring in parallel. At the same time, costly infrastructure and regulatory changes are demanded. Furthermore, new, most often fintech players are entering the market. With all these elements moving at the same time, it's difficult for corporates and even more for payment service providers to have a clear view on how to position themselves for the future. The essential, basic and fundamental trend is clear. We are moving to an environment where payment transaction will be instantly, contactless and for free. The general long-term consequence for payment service providers is clear as well. An earning model based on transaction fees is not sustainable. Future profitability will come from the provision of data-driven, value-added services. But just knowing the general trends is not sufficiently for building a long-term value business model. In particular, for small and medium-sized organizations, it is too costly to participate in all ongoing initiatives. Choices need to be made, and making the good choice is especially important if we take into account that in-depth transformation with an unclear return on investment are required. We already know some initial important building blocks underpinning the business model of the future: embracing open banking, developing cross-border instant payment services, adapting to new and changing infrastructures and international standards, and finally, taking into account the growing trend of tokenization. But this is not enough, because every payment service provider situation is unique. Hence, we propose our clients a tailored approach. After a SWOT analysis of the current situation, we define potential future scenarios taking into account competitive advantages, profits, costs, and risk. The final outcome is the definition of a sustainable business model for payment services.
So great. We thank you for watching this video, and please do not hesitate to contact Eric or myself if you want to discuss further this interesting topic. Thank you.
Thank you.
Thank you very much for this very interesting presentation. And now I would like to introduce our next speaker and the theme they will present. We have the pleasure to welcome Damien Degros, who is Head of Wholesale Banking at ING Bank Luxembourg. Damien will talk about the necessary transition and evolution post-health crisis and challenges ahead. We know that there are many of them. Looking forward to listening to your presentation. Damien, the floor is yours.
Dear François and dear guests, Elodie Ruch, in charge of sustainable banking, and myself, Head of Wholesale Banking at ING Luxembourg, are happy to participate in the conference today. Philippe Ledan, senior economist of ING, will join us and will give an update on market conditions. When I was contacted by François regarding the topic necessary transition and evolution of the finance function, I confirmed the two topics we would like to present. The challenge of liquidity management for a bank and the key role a bank can play in sustainable financing. Let's start now. As a bank and as a corporate, this year is clearly different. But it gives us the opportunity to test our ability to adapt ourselves in such an unexpected context. Philippe, how can we illustrate that the current economic environment was unexpected?
Yes, sure. It was, I would say, unexpected, unprecedented, and huge. It was a huge shock that we've never seen in peacetime, I would say. Just to illustrate this, if you look at this slide showing the loss of activity during the first half of this year, you see that for many countries there is a loss of about 10 to 15% compared to what happened, or compared to the level of activity that we had at the end of 2019. So it's incredible. For many countries, it is 3, 4, 5 times the shock of the financial crisis of 2008, 2009. For Luxembourg, we don't have the number for the second quarter. There was already a drop of 3% quarter on quarter of GDP during the first quarter, but probably that it will be to the tune of that number also, minus 10 to 15%. So it was unprecedented, it was huge, and of course it was unexpected. From the beginning of the year, we knew that there was a risk with this pandemic starting in China, but of course the consequence of this type of shock is it's not possible to compute that, and even up to the last moment you consider it more as a risk, because it's very difficult to consider that now it's your base case to consider that there will be such a consequence from this pandemic. Now, of course, we have to accept that, and we have to modify our forecast knowing that. But it was really unexpected. And you can see also on the second graph that for central banks, it was also, of course, unexpected. And they had to take drastic, very aggressive measures very early in March to stabilize the market and to counter the negative consequence of the pandemic. And it was certainly the case in the US, because there was really the fear of having a financial crisis, and certainly on the money market, where you can see on the graph that the interest rates were increasing a lot, because there was a fear that there would be a lack of liquidities for companies. And to counter that, of course, the US Central Bank, that increased its interest rate over the last 2 years, started to decrease, to make a strong decline of its interest rate, of course. And they also take a lot of measure to put a lot of liquidities in the market to stabilize the market and to erase the fear for companies for not having enough liquidities. And so this very aggressive action made that indeed financial markets stabilized quite quickly. I'm not speaking only of equity market, but more importantly, money market in the US, avoiding having a financial crisis and putting a lot of liquidity, enough liquidity in the different markets in order to stabilize and to restore confidence, I would say.
Very low interest rate, huge amount of liquidity, drop of GDP. What does it mean for the banking industry, especially in liquidity management? You may know that the regulator has decided some measures on solvency and liquidity to protect the clients of a bank. Most of you know the capital requirement a bank has to deal with for the lending activities. Regarding the liquidity, there are also constraints a bank has to respect, mainly the liquidity cover ratio or LCR. During the last financial crisis, a failure to adequately monitor and control liquidity risk led a number of financial firms into difficulties in the years 2007, 8, and 9. BCBS introduced the LCR in Basel III. It is designed to ensure that banks hold a sufficient reserve on high-quality liquidity assets, HQLA, to allow them to survive a period of significant liquidity stress lasting 30 calendar days. In other words, the LCR is a stress ratio that tells banks whether they can stay liquid, thanks to the high quality liquid asset buffer, despite erosion of deposit if the bank is less trusted by its depositors. LCR, it's actually a ratio dividing high-quality liquid assets by the total net cash flow, the net cash outflow over the next 30 calendar days. The regulator wanted to ensure the ability of a bank to deliver upon a request of a client the cash related to a deposit at any time. So, no surprise, the regulatory requirement is 100%. You could think the less net cash outflow you have, the less high-quality liquid assets you need to keep the LCR at 100%. But the devil is in the detail, as in order to calculate the net outflow, you need to take into account the inflow, actually lending assets which come at maturity, and the outflow, deposit leaving the bank. And the outflow of a deposit depends on the volatility related to the nature of the client and on the average financial behavior of that client. Here is where it becomes tricky, as not all deposits are treated the same. For example, the outflow rate for a deposit of a corporate with an operational relationship is 60%. An operational relationship between a bank and a corporate is a relationship where most of the banking activity of the corporate are concentrated with the bank. To compare, the outflow rate for a retail saving deposit is only 5%, and for a financial institution is 100%. The conclusion is that the banks are keen to have access to retail deposit as it is more stable from a liquidity point of view. Philippe, can you tell us about retail savings in the current market?
Yes, sure. So, of course, during the lockdown, people were forced to save. But okay, that's important. But that's maybe not the most important thing. The most important thing is in the current situation, because now there is still plenty of uncertainty about the future of the pandemic, and so about the future of potential lockdowns and the economic consequence of them. And so, in such a context, what we observe is that, okay, while people fear the future, when they fear the future, they will tend to save more. And it's a little bit like companies. We also know that if there is a lack of activity and a big uncertainty, most probably, that they will revise downward their investment plan for the future. So, in situation of uncertainty like we are now about the future, what will happen in the coming months, waiting for a vaccine, we know that people will not consume a lot and will prefer to save, and companies will not invest a lot. They will prefer also to keep their money. And for the retail, it's quite clear here on the picture. You see that it's a survey made on consumers all over the Euro area, and of course all these surveys show that the people they expect to save more in the coming months, and it's not due to the improvement of the economic situation, making that they can do that, they can save more. It's just a consequence of the fact that they fear the future and they prefer to save than to consume. So that's quite clear that for retail saving we will continue to have a lot of saving, and that's, I would say, a quite classical evolution in recession. It's a little bit counterintuitive, but we observe that the saving ratio of people tend to increase when there is a recession, for example.
Philippe, it looks good. Plenty of retail cash. Any other topics which could be interesting?
Yes, sure. I would add that if you look at interest rate, I told you about the US interest rate, but of course, in the Euro area, interest rates were already very, very low, and the ECB continued to push downward, a downward pressure on interest rate. And so what you observe now is that on the money market, on short-term interest rate in the Euro area, they remain very, very low. If you look at the forecast, at the expectation of central bank, they will keep interest rate very low for a very long time in the US, in the UK, all over the world, certainly in the Euro area. So it's troubling, of course, that okay, for a saver, they save a lot in a period where interest rates are very, very low. That's counterintuitive, I would say, but in the current circumstances, probably that it's not the first objective of an investor, of a saver, to have plenty of interest on his saving. But it's a strange situation, of course, also for banks, because we are in a context where short-term interest rate, long-term interest rate, you also observe on the picture, the long-term interest rate are very, very low, and the ECB is also pushing downward long-term interest rate. So we are in a very strange situation where all interest rates are very, very low, and this is, of course, a big challenge for a commercial bank to manage this. But I'm sure you have more to say on that.
The situation is then the following. We look after retail deposit from a liquidity point of view. Next to the liquidity, we need to make sure the liquidity is accessible at an acceptable pricing for a profit criteria. Is a retail deposit at 0% still attractive? We know that interest rates are and will be negative for a long period. We know also that the total of cash cannot be used totally for lending activities. And we notice that investment and consumption are relatively low for the moment, and therefore the banks remain with a lot of cash, which will become a deposit at the central bank. It means the funding or liquidity aspect is becoming very expensive. In this context, banks have three ways to maintain their profitability or keep what we call a cost income at a decent level for the stock market. First, by managing their expenses. Second, by increasing their interest margin. Reduce interest rate on savings or increase margin on credit. And by increasing the fee business on investment and on servicing. Most of the time, banks combine the three options, and they have already started to charge deposit from institutional and corporate clients, to reprice some services, and to reduce the expenses like most of the corporate are doing. The goal of my presentation was to give you some information on the importance of operational relationship with corporate clients for a bank for liquidity management purposes. The potential increase of serving fees in order to compensate the decrease of interest margin, and the regulatory constraint a bank has to deal with. Those topics will have an influence on the transformation of the finance function. It's time now to speak about another very important topic, which has impact on the necessary transition and evolution of the finance function: sustainable financing. Philippe, do you have any comments on the topic?
Yes, if I may, and I think it's a good transition to the next part of this session. It's the fact that this shock, this big economic shock, plays also a very important role in the transformation of our economies. Because we know that an economy is always transforming itself. But probably that in the current situation, there is a sort of acceleration of this transformation. And that existing trends that were already there before the crisis are now accelerating and developing. And as you can see on this slide, I would certainly point the digitalization clearly, the typical trend that was already there before the crisis, the digitalization in many sectors. And now there is a strong acceleration of this trend. And probably that there will be no coming back to the pre-crisis situation. Probably that the evolution will accelerate. And I would make the same comment on the development of a more sustainable economy. It was also a trend that was already there before the crisis, but if you look at the recovery plans at the European level, at the national level, they clearly want to accelerate the transition to a more sustainable economy by more investment, by taxation, and so on. So I really think that the transition to a sustainable economy will also be a trend that will be accelerated by this huge shock.
Sustainable finance and the related focus on innovation and product development can be a driver in the evolution of the finance function toward a better future. I will share with you an overview of existing sustainable lending products and a market update for the first half of 2020. There are actually several sustainable finance solutions to support a company's green ambitions. I will elaborate a little bit on the green loan and the sustainability-linked loan, also called the sustainability improvement loans. Let's start with the green loan. A green loan is simply a loan to finance an asset that can be qualified as green. It means that there is a dedicated use of proceeds toward this asset in particular. It can be a lot of things, and sometimes it is quite easy to classify. For example, in the case of a building that has a good or very good BREEAM certificate, or a GRESB rating, or for a solar panel installation, or wind turbines, or electric buses. But it can also be a bit trickier and less straightforward when we take, for example, a boat or a production line. A sustainability-linked loan, however, is a loan where the borrower is encouraged to improve its sustainability performance through a financial advantage, represented by a lower interest rate. So basically, we will measure the sustainability performance of the borrower at the inception of the loan, and we will set ambitious objectives to improve the performance within the lifetime of the loan. As the performance improves, the objectives are met, the interest rate on the loan will decrease. But if the performance deteriorates and the objectives are not met, the interest rate will increase. Now, how can we measure the sustainability performance of a company? There are two main ways. First, the company can have an external sustainability rating provided by an independent rating agency such as Sustainalytics, MSCI or EcoVadis. It is a dedicated rating that will give a score in function of the performance of the company in the environmental, social and governance areas. In this case, we will set an objective to increase the overall score by 5 or 10 points, for example, depending on the starting score. The second option is to determine KPIs that are relevant with the sustainability policy and ambitions of the company. We usually have between 3 and 5 KPIs for which we set objectives. If the objectives are met, the company gets the discount. There is a huge range of KPIs from CO2 emissions, tons of waste, water consumption, but also the percentage of women in the board or employee satisfaction. The main benefit of a sustainability-linked loan, besides the financial advantage, is that the financing of the company, becomes related to its sustainability performance, which is something that could really help companies to face the challenges ahead. It also creates a compelling communication opportunities for investors, customers, and all the other stakeholders. Let's note that, on the contrary to the green loan, a sustainability improvement loan is a general purpose loan. So there is no dedicated use of proceeds and no identification of green assets. For about a year now, the same principle has been applied to fund financing, with the first sustainability improvement capital call facility, whereby the interest rate on the facility depends on the achievement of certain ESG performance targets on the fund portfolio, which is really interesting as well and gives us a lot to think about, given the huge amount of possibilities to develop this in our local market in Luxembourg. Now, if we move to the market update, it will be brief, but it is good to mention that the green loan and the sustainability-linked loan markets share have remained stable during the COVID-19 crisis. 230 banks offered sustainable lending worldwide, with more than 300 transactions globally since 2017. In the first half of 2020, 78 syndicated green loans and sustainability-linked loans with a total value of more than 50 billion euros were issued, constituting a 17% increase in the number of deals compared to the first half of 2019. However, the first half of 2020 volumes show a fall in biannual growth, with a 22% decrease in deal count compared to the second half of 2019. EMEA market remains the biggest participant, with 54 deals closed, with the main players being the Netherlands, France and Germany. The green loan, the sustainability-linked loan, are just the first in what I'm sure is the new phase of the finance function. We have an important role to play in society, facilitating an efficient economy and the safe and secure financial systems it depends on, supporting people to be financially healthy and fighting climate change. As the saying goes, stronger together. Thank you.
Thank you very much for this very interesting presentation. And now I would like to introduce a panel moderated by JP Morgan. The subject that will be addressed is the following: navigating your treasury career journey, inclusion and mobility, thriving in a virtual world. It is extremely important these days to ensure diversity, and the place of women in treasury is really essential. There are more and more women in finance for a couple of years, and we should tend as much as possible to a perfect parity. The panelists will share with us their career journey and experience in treasury. A very interesting program. The panel will consist of Rafaela Cova de Lima, Treasury Director EMEA at Koch Industries, Coralie Bielman, Head of PayPal Europe Treasury and Investment at PayPal, Winky Shaw, Director of Global Cash Management and Assistant Treasurer at Amazon, Soraya Ahmed, Executive Director Global FX Exotic and Hybrid at JP Morgan, and eventually Veronique Steiner, Executive Director Corporate Investment Banking at JP Morgan. Ladies, the floor is yours.
Good afternoon and welcome to all of you. As part of our JP Morgan Women in Finance series, I'm delighted today to be moderating this inspiring panel at ATEL 2020 annual conference. My name is Veronique Steiner and I head up wholesale payments high growth tech segment for JP Morgan in Europe, Middle East and Africa. While we are all striving in our virtual world, we are happy to be all today on stage. Thanks to technology, I'm delighted to be able to welcome 4 women leaders who will join me in this panel, where they will share more insight around their career journey, but also around diversity and inclusion. With no further ado, let me bring you in our panel. Joining us today, we have Rafaela Cova de Lima, EMEA Treasury Director at Koch Industries, Coralie Bielman, Head of Treasury PayPal Europe, Winky Choi, Head of Amazon EMEA Treasury, and Soraya Ahmed, Head of Trade Sales EMEA at JP Morgan. So welcome, ladies. Let me start off, by a kickoff ice-breaking questions. So to you, Rafaela, as a Brazilian based in Luxembourg, what is your favorite food to eat?
In Brazil, we have some cheese buns that we can eat as snacks or as breakfast. You can eat at any time of the day. I really enjoy them. It's one of my favorite food. It's not that easy to find them here in Luxembourg, but we managed to make them at home, and we can do some adaptation by using like local cheese and some other type of items, but it's really enjoyable.
Wow, it looks delicious. Thank you. Coralie, where is your favorite place to travel?
My favorite place is a very small village in the south of Greece called Myrtos. It's just a couple of houses and restaurants and the coast, and everything looks fabulous there. The food is delicious, very cheap, and we enjoy going there every summer for 20 years now.
Well, I want to discover that place as soon as we are able to travel more easily. So Winky, you have a busy day job as head of treasury. What do you do to switch off from work?
You're assuming that my switch has an off button, but I actually don't. So pre-pandemic, my way of kind of slow down and not thinking about work as much is that I kind of go outside and go run. And I also do running and swimming as well. I live across the street from an Olympic-sized swimming pool. But now in a pandemic era, then I just do running in the morning and basically do the things that most of the adults will have to do, the parents have to do, is do the laundry, take care of the kids, and cook. So that's another way of kind of, not thinking about work during the day. So, yeah.
Great, thank you so much for sharing. Soraya, so you have lived all over the world. Where is your favorite place?
Good morning, thank you. Well, my favorite place, and I had the privilege to live there for 8 years, is Italy. So I spent a lot of time living and working in Milan. And my favorite place in Italy is anywhere by the sea.
Thank you, ladies. Coralie, let's continue with you. Can you give us a brief description of your career journey so far?
So I'm basically an investment professional, passionate by financial markets. So I started my career a long time ago already as a fixed income fund manager for investment banks and then hedge funds, either in Paris and then in London and then in Luxembourg. I discovered Treasury by chance when I joined PayPal 7 years ago, thanks to Winky as well. we had the chance to meet before my first day at PayPal. And basically, I really enjoy Treasury within a corporate environment, thanks to the broad activities that covers. It's not only buying or selling bonds, it's as well structuring a balance sheet, it's enabling business to grow. So this is why Treasury is very often at the center of all the core activities of a corporate environment. It's extremely fast-paced, dynamic. Not a single day is the same that previous, so really enjoyable environment.
Thank you, Coralie. Really inspiring how you've been able to adapt in new roles and in new environments in such a way. So moving now to Rafaela. So reflecting on your various stages of your career, are there any key moments that were really important factors in your career progression?
I think never being afraid to take on new challenges or being proactive and hands-on. I feel that like if you embrace it, or you're still, even if you're not very comfortable about implementing new banking structures or complex financial products in a different region or in a different country that you're not very familiar on, I think just that like being very open to that kind of challenge, that it helped me and enabled me to proceed throughout my career around the world.
Wow, I love the energy. Thank you. Winky, what got you interested in corporate treasury career? And could you give us also a brief description of your journey so far?
How I entered into treasury, it's somewhat by an accident. I actually started as an engineering manager, managing a systems team developing imaging system for HR, as well as developing and setting up a call center for India. And slowly moved over to PayPal because of personal reason. I actually moved to California and work on supporting their treasury and accounting. And one of the things at the time that I did was to set up an FX netting for the company, basically centralize the whole process in Singapore. And then we also did an implementation on a money market fund, which is, by the way, at the time was #1 in the country. And then I was asked to move on to another project because the organizational change, but I wasn't ready to move because the system was still kind of halfway implemented, and so I would like to stay. And then the treasurer at the time was really appreciative of someone who actually understands the systems and also understands the business because of my background and also in finance. So I kind of stepped into the treasury role at that time, and that was the beginning of it. So I essentially changed into more of a treasury professional, and then from there on, I ended up taking the opportunity in Luxembourg, and then into the corporate treasury role.
Well, very exciting projects. Thank you so much. Coming to you now, Soraya, what is the biggest challenge you have overcome so far in your career, and how did you navigate it?
Right. I think the biggest challenge for me, or challenges I would say, is really when I have moved country and changed and come out of my comfort zone in terms of a job or a product proposition that I've worked on for some years. But I think that's just part of one's career and professional growth. So I have had the opportunity to have worked in Pakistan, in London, in Italy, and I hope that journey will continue. But I think around the point of navigation, it's all based on the will to learn more, to grow more. And I think just talking about a particular situation where I moved out of origination and sales into product, it was more about learning literally from scratch, points around documentation, structuring, credit, risk, etc. That I think one has to approach that with the spirit that you're going to learn, and I think you're personally engaged in that because you just want to grow from those experiences. But most importantly, I think, is not to be too hard on yourself. I think the most important thing is, even at a management level, managers are also very, very keen to have new talent. And I think there is a definite understanding that it can take a little bit of time before you come to grips with a new product or a new proposition or a new country that you might choose to work in.
Thank you, Soraya. Through your different answers, I have noticed that some of you not only evolved in your careers, but have also largely traveled to be able to accomplish this journey. So Winky, back to you. Can you share one of your mobility stories, either geographic relocation, or different roles, and what made you leave your comfort zone to meet this new challenge?
Well, first of all, my comfort zone, the way I would define it is actually leaving a company. Because to me, if you do in a different role within an organization, you're still within the comfort zone because your knowledge, you know that you can access your colleagues who's there to help you out to grow into knowing your job or knowing how to accomplish your responsibility. But once you move to another company, you have to start from scratch, including building new relationships and learning the job and learning the corporate culture and the policy, etc. So to me, that was really the hardest thing to do. But at the same time, you see that in a new challenge come with a new rewards as well. So from a location perspective, usually when I moved, it was due to the personal reason. So while I was in PayPal eBay, I had 5 different jobs. So that was from California to Luxembourg. Not an issue because I'm still having access to the colleagues. But when I changed from the PayPal eBay world into Amazon, that's really a brand new thing. But I also realized that there's a great deal of opportunities at Amazon just because it's a big organization. They touch on a lot of different business line and products. So I think that with that in mind, I was able to kind of expand my knowledge. To me, that is very important. Think of it as that you're going to be able to grow into something bigger than you were before and can have fun to do it. That's a way to kind of reward yourself in any career.
Well, thank you for sharing so much. It's really incredible. And I love the way that you're bringing these opportunity and challenges to us. So thank you for that. And Rafaela, now to you. I know your career so far has brought you to many countries, I understand, and I am sure I'm missing some: Brazil, Ireland, US, Luxembourg. Tell me about that journey, please.
Yeah, so I'm a native Brazilian, as you mentioned, and I spent most part of my studies, except for some months in Ireland during college, but beginning of my career, all the years of that beginning was in Brazil. I worked always for multinational companies and mostly on the oil and gas industry. But some years ago, I decided to take a sabbatical to learn French, and that's how I ended up in Luxembourg, actually. So after 5 years being around here in the US, so I joined Guardian Industries, which is part of the Coke group, in 2015, and in 2018, I took an opportunity to lead the Americas team over there. And that made me spend 2 years in the US, and now I relocated back to Luxembourg in the beginning of this year. So yeah, I've been, as you mentioned, right, like around countries, but I'm always open for new challenges. I definitely will keep embracing new relocation opportunities. I like moving, I like seeing different environments and having this discovery perspective of having to adapt yourself as well. I think it's a good challenge, and I really enjoy it.
Thank you so much. I fully appreciate your traveling. I've been myself traveling a lot throughout my life, and I think that is amazing opportunities to indeed discover new cultures, new people, and have to adapt. I think it's a day-to-day challenge. So congratulations on that path. Coralie, now looking back on various stages of your career, what would you say were the most important factors in your career progression?
I would say the basis are really the technical skills.
at the beginning. It's really important for treasury professionals to have established really a knowledge about not only the systems, but what can and cannot be done in a treasury environment. And I really emphasize the fact that it's not really at school that we can learn this really. So I really encourage treasury professionals to go for postgraduate qualification like CFA or really like treasury chartering. It's really important for us to build the technical skills first, and then only we basically build the knowledge and the interest in all treasury matters basically. And from that we can really grow. We can go shoot for more responsibilities all the time, shoot for success. And do not hesitate to raise your hand or to volunteer ourselves for anything, even if it's not really treasury specific. Go beyond the box, basically. This is what I do almost every day. Treasury is always touching different aspects of the business, and we need to go always above what is really expected from a pure treasury responsibilities.
Thank you so much, Corradi. And this leads me to a question now on diversity and inclusion. JP Morgan has a clear commitment to diversity and inclusion. In a company of more than 250 employees, we have approximately half of our staff is female. But of course, diversity and inclusion is about more than just empowering a woman, right? So Soraya, can you tell us a little bit more about things that have changed since the sad George Floyd's death?
I think there have been great efforts from all places, and that's what I found in terms of my personal and professional life, and I hope you are seeing that as well. At JPM, we are focused on a culture of respect and inclusion for many, many years, but literally what happened hours, days, and weeks after George Floyd's death is something I will never forget, and something I have never seen, especially at the workplace. And by that, I mean literally from the top of the firm, our chairman and CEO, Jamie Dimon, spoke out directly on the events and the systemic racism and unconscious bias that still manifests itself all around us. And since then, we also have a new global diversity and inclusion head who engages with all our businesses across the world to ensure that those dialogues, that awareness, the drive to change is committed on and takes place. And by that, I specifically mean management training that's been done. Significant hours have been put into this, a commitment to diverse job slates. And I think really interestingly and importantly, driving more and more diversity and inclusion hiring commitments by the top 200 managers in our firm.
Thank you, Soraya. So now I'd like to end this interview and panel with final sweet and short tip questions. In 2019, survey of women in Treasury conducted by Treasury Today, 70% of respondents said that they consider mentoring, coaching, and sponsorship very helpful. I personally do. To develop your successful career, you need a coach, a mentor, or sponsor. Corrali, can you tell us about mentors or sponsors that have been important in your career?
My mentor, I only have one, gave me this advice a long time ago already, almost 15 years ago. And it's only one: keep your enthusiasm. Short and sweet. And I think I remember this almost all the time. And when you lose your enthusiasm, then it's time to go or time to shoot for more. But it's really an important tip.
100% agreed. I mean, if work is not fun, we spend so many hours in our jobs that, why worth it? So now moving to Rafaela, any tips for the next generation of female leaders as they may consider finance and treasury roles?
I think it's very important to keep being resilient, be proactive. It's very important to understand make sure that you are enjoying what you do and you can find fulfillment. I think that's the main goal that you should seek in your life, in any career, right? And one item that I really enjoyed and I always approach that way for myself as well is like having an inquisitive nature, right? Like always asking questions, being honest about your own limitations and everything. That helps a lot as well.
Thank you. So I hear, don't be shy, ask. Winky, so last question for you. I think this question is really, insightful, and I want to ask to you as well, what are your tips for the next generation of female leaders?
I think what Coralie and Raphael mentioned is absolutely right on the spot. You have to have the enthusiasm. You got to have to be resilient. But you also got to know yourself. What are you interested in? What makes you to get up every day? So with that in mind, you got to have the right attitude. And I always come across with how people get inspired. And I think that one of the things when I joined Amazon, they have 14 leadership principles. And I think there are a couple of them that really resonate with me. And to me, the advice I would love to tell them that how I would get inspired myself by identifying that I want to do these things, it's where you think you will get your success. So the top 5 of them, in my opinion, learn to be curious. So always try to find out why you want to know more. Deep dive. You don't mind to get your hands dirty and you want to know more about it in detail. Why? What drives that? Invent and simplify. Once you get to know why, then you try to figure out how can I improve upon it? How can I simplify it? What makes it less equals more? Then it will go to think big. Now you take a strategic level view of how I can look at this small piece and become a bigger, fit into a bigger picture. What does it mean for corporate, So you got to think about outside the little box. And lastly, to me, it's also very important throughout the whole journey would be insist on higher standard. No matter what you do, it's the quality that matters. Don't rush and don't think that doing more is better. It is not. So always keep in mind your quality and integrity should always come first. So if we keep in mind those things and identify what drives you, get you wake up every day, and I think that's a ticket for your success. And I think it's not just for Treasury, it should be for anyone who try to identify what excites you every day, and you want to do more, and you'll be successful in it. And so those are the tips that I at least that's how I drive myself every day, thinking about those principles.
Well, that was an amazing feedback. Thank you so much, Winky. Ladies, I think this was a perfect way to also finish our discussion. I'd like to thank you warmly for the time that you have given to us today. I think it was really insightful. I hope everybody will take what I learned as new tips and tricks to be able to move forward, to take back also inspiring careers, to make sure that people go forward, are curious, have the aptitude to adapt, but also meet the standard that they want for their life. So thank you very much for taking the time. We really appreciated to have you with us today, and thank you.
Dear members, dear participants, I wanted to thank all of you for your attendance to our second e-conference of ATEL. I know we have a lot of foreign participants and you are always more than welcome to attend our next events in fall and our Christmas conference in December. Please send us a message via our website and we will invite you. I also want to once again thank our sponsors. Intensum, a long-standing partner of ATEL, this innovative company is celebrating its 15th anniversary this year. Congratulations to them. I also wanted to thank BNP Paribas, Bearing Point, ING, EY, and JP Morgan for their presentation and support. I hope you have enjoyed this conference. I wish you all the best in these challenging times. Take care.